Hey, it's Joey Tries Finance here to tell you about investment analysis as defined in preparation for my Series 65 exam. Let's go. So there's two major baskets of investment analysis, starting with bottom up and top down. So bottom up is focusing on one company and then going up to the whole market. And then top down is the opposite. So that'd be looking at a whole market and then seeing what company matches that market or what's overperforming in that market, that kind of thing. And then we have fundamental and technical. Fundamental is looking at the financial statements, seeing if a stock is undervalued, because then theoretically it should grow, right? If it's meant to be worth more. And then technical is like finding the most effective way, being super tactical, trading all the time, seeing trends. It's more nitty-gritty, graphy. Now for the nitty-gritty, the bottom up, top down. So bottom up is more microeconomic. It's focusing on the little bit of the company, like things that affect it. It's almost like they're focusing on the unsystematic risk. Now, while the top down is almost focusing on the systematic risk, like the overarching who performs well in here, because that can't really be diversified, but you can be like, well, it's clearly doing something different and it's working. So top down looks at an industry and weighs the market a lot, while bottom up finds stocks that outperform their industry for whatever reason. As I've said previously, fundamental is looking at those financial statements, misprice, price to book ratio, that somebody underlooked this stock and it's actually doing really well, and that you should invest in it because their management's doing great, but it's just an undervalued stock. So eventually it's going to do great. They're trying to figure out what it actually should be worth because they're looking at it on the financial statement. They also use the bottom up approach, mostly common, like these can mix and match and they can work together because they're looking at a specific company, its financial statements, and then you'll assume with the technical side, it's the other way around where they're top down and looking at all that stuff, as well as the future prospects of the company. It's what fundamental is doing. They're also looking at deals that they're going to do, acquisitions for stuff, things like technical is looking for those patterns. They're trying to be efficient price movements, day trader type of thing. A day trader is going to be very technical, using the computer to know the best time to buy and sell as well. And they believe that they can beat the market, but only through active trading often. And they're not fans of holding a stock. If they believe in this, it's very rare that they would hold a stock for very long because they're like, oh, I'm wasting money not efficiently dropping this when it gets below a certain point and things like that. So now why do people have these thought processes of how these work? This is because of theories, efficient market hypothesis to be specific. But there's three different forms of this efficient market hypothesis, starting with weak efficient market hypothesis, which believes only private and fundamental analysis can change someone's position in the market. They believe that no matter what, you can have an effect on the market, except there's not a bunch of tiny little trends. You can only beat it by knowing information about a single company kind of thing. And then we have semi-strong efficient market hypothesis, which is a stock is determined by all public info. So they believe that private information can give you a go-ahead, but that's the only time. Fundamental and technical analysis, they don't believe is viable here, only private information. And then strong efficient market hypothesis is that all knowledge, public and private, even information that has not been given out, is reflected in a stock's meaning. Therefore, its cost and everything is already applied. And so it's not going to change because of this, because it's all active. And therefore, you can have no advantage in the market, and there's no point in active trading. So these are people that are like, just follow the market, stay, keep something, and you can't consistently outperform the market regardless of how hard you try. Thank you guys for watching. Tell me which theory you think is best down below based on your thoughts. Tell me all about it. Love to hear it. God bless. Remember, knowledge is power.